Hello and welcome back to our lesson on risk and return. We continue from where we left off the last time by looking at the covariance. Now, when we talk about the covariance, we try to measure the directional relationship between the returns of any two assets. When we have a positive covariance, it implies that the asset returns move together, while the negative covariance means that they move inversely, meaning that they move in opposite direction. Now, covariance is a very important tool, especially in modern portfolio theory, because we use that to ascertain which securities to put together. Now, to reduce risk and volatility in a portfolio, we normally seek to pair assets that have a negative covariance. By implication, whatever gains may be made in one, once you have determined your average portfolio return, whatever gains are made in one will be offset by the other, giving you a relatively stable return on your portfolio. In the other reverse, when one asset loses on its returns, the other one is going to gain. That is, if they have inverse relationship, the other one is going to gain something similar, or depending on the level of variation. So that also then helps you to keep a very stable return on your portfolio. Now let's look at an example here. Under the stock fund variations that we computed, you realize that during the recession, the stock fund had a variation of 18%, under the normal scenario had 1, and then the boom, it had 17%. For the bond fund, it was 10% for recession, 0 for the normal, and negative 10% under the boom. When you take the product of the two, you end up with this, and then when you weight it with the probability of each of the scenarios, whether the recession, the normal, and the boom, together you have a negative 0.0117, which implies that these two investments or these two assets move in opposite directions. So we may want to then pair them. Now, let's go on to look at what happens behind the scenes. Now, comparing variance to covariance. When you look at the variance, for example, variance is captured as the sum of the probabilities into the variation squared. Now, expanding just one side, let's say for the recessionary period, we are going to get a case where the probability of the recession multiplied by this squared, meaning that we have the actual return less the expected return multiplied by itself. So it means that when we are talking about variance, we are talking about how a particular investment varies about itself, literally. When we come to covariance, we are seeing how two vary about each other. So under the same recessionary phase, now we are interested in how the stock fund varies, even as the bond fund also varies. That is where we take the product of the two and then we scale or we weight it by the probability. Once that is done, we end up with our covariance. Now, the covariance just tells us whether they are positively or negatively related in terms of movement. But when we want to give it a bit more of quantification, whether we want to look at a one-to-one mapping of a kind, then we go on to compute the correlation coefficient, which is captured easily as the covariance that we have computed divided by the standard deviations of the two securities that we are interested in. So in this case, we take our computed value of negative 0.0117 and divide that by the standard deviations of the stock fund and the bond fund. And we end up with a negative 0.998. What it means that for every positive or negative movement of 1 in one of the assets, the other would also change in the opposite direction by 0.998. This is almost near a perfect negative correlation. So now let's see how that plays out. Take an example where that we have, note also that the stocks typically have higher expected return than the bonds and also higher risk. So now let's turn now to, let's say, a portfolio that is constructed with 50% in bonds and 50% in stocks. Now the expected return is therefore the weighted average of the expected returns on the individual securities. So here we have 50% invested in stocks plus 50% invested in bonds. Now that gives us an expected return on our portfolio of 9%. Now when it comes to the variance for the two risky assets, that's the stock fund and the bond fund that make up our portfolio, the variance for the portfolio is captured with this formula where we have the weight and the variation of the individual securities squared, and then we have this function of 2 into the weight of the individual security and the variation, and then you can see that this is a complete product to the end, and this here is the correlation coefficient which we computed between the two returns on the stock fund and the bond fund. Once we put that together, we take the square roots, then we get the standard deviation. Now look at it critically and realize that even as we square the deviation, by diversifying, therefore moving our stocks from just a stock fund or just a bond fund and putting them together, in this case a 50-50, we realize that this particular portfolio has less risk than either the stock alone or the bond fund alone. Now this is literally the principle of diversification. Now what we can now do in trying to find out, so what kind of combination should we do for this particular set of risky assets to arrive at what we'll call an efficient set. So take this example where you realize that we have 0% in stocks, which implies that all our investment is in the bond. We get a return of 7%, but our risk is 8.2. Now, even as we put 5% in stocks and therefore 95% in bonds, our risk drops and then our return actually increases. So here it obviously means that a 95% in bonds and a 5% in stocks is way better than a complete investment in bonds. And so we continue with the same combination up until the point where we have a reduction. So look at the case for the 50-50 example we did. Now if you look at it critically, you can see that even as we invest more in the stocks, the return goes up, but for a period, the risk profile keeps on dropping. Now, by the time we drop to 0.4, that seems to be the lowest points that we can have with a combination. Beyond that, obviously the risk begins to rise even as the return is also rising. So when we plot everything, this is what we're going to get. So we have everything in bonds through to a combination of stocks to the very end. Now, this combination here is what we refer to as the efficient set. The efficient set because if the x-axis here captures risk, whilst the y-axis captured returns, what you do notice is that as for a number of these investments here, for the same level of risk, we have lower returns on these ones here, but we can get higher returns for these ones here. So then it makes obvious sense for the finance manager to focus on the ones that fall within the efficient set, because for this particular investment, the risk may be almost similar to anything here, but the returns are way better. So that is also one of the lessons you derive from knowing the correlations that exist between any two sets of assets. So obviously some portfolios are better than others. Now that brings us into the principle of diversification. Now, by spreading our investments across a number of assets, we can substantially reduce the variability of our returns without reducing in equivalent manner the expected returns. Now this reduction comes about because worse than expected returns from one asset are usually offset by better than expected returns from the other. However, there's a minimal level of risk that we cannot do away with, and that we refer to as the systematic portion. In one way, you can say that systematic portion refers to the system, And that one is the risk that most people or nobody can really do much about once you're operating in the system. So if you look at it, this typical diversification graph that we have, or that reflect diversification, the more we increase the number of securities, our N, then the risk for the portfolio reduces. And the reason it reduces is because as we diversify away from a concentration in just some specific investments, the risk inherent in those individual unique investments give way. But of course, we cannot do away with the base risk, which is normally with the market. It is with the system. And it flows from a number of issues such as changes in GDP, which affects the entire economy, inflation, interest rates, etc. Now, when it comes to unsystematic risk, which is diversifiable, this normally comes from things like labor strikes, shortages, etc. Now, this is referred to as unit risk and asset specific, meaning that once you begin to move away or move your concentration of investment from certain assets, you also begin to reduce the risk that is inherent in those specific assets. So once you try to combine a number of assets in a portfolio, your diversifiable risk, or what we refer to as unsystematic risk, begins to ebb away. So that our total risk, captured usually by our standard deviation, has the component of systematic risk, which we can't do anything about, plus unsystematic risk. And so then we try to diversify our portfolio so that we can reduce unsystematic risk to very negligible portions. So that when you have a very well diversified portfolio, essentially the risk you have in there is just your systematic risk. For that reason, when you're holding on to just a systematic risk, we refer to that risk as the beta. So the typical beta now tells us how that particular portfolio or that investment package moves with the market. And that is what, so we have the beta, and this is captured as the covariation between that investment and the market, and then the variance of the market. So this is clearly your estimate of beta will depend on your choice of a proxy for the market. So now let's turn to the capital asset pricing model. Now, according to the capital asset pricing model, there is a way to map the relationship between risk and expected return. Now, how does that play out? According to this model, when you construct a market portfolio, meaning that you're able to construct a portfolio that has a large pool of individual securities that makes it quite well diversified, your expected return on that portfolio is actually made up of two parts. First, a component we refer to as, let's say, your base risk, but normally referred to as the risk-free rate. It means the return for holding on to no risk. Then the actual compensation for the risk that you hold on to, because remember that in a market, you're currently in a well-diversified portfolio, you're holding on to what? Systematic risk, which is referred to as the beta. Now, when you extend that thinking to individual security, then you can say that the expected return on an individual security is made up of two parts: the risk-free rate plus the compensation for systematic risk. Now, the compensation for systematic risk is captured as the beta, or the systematic risk measure of the individual security, multiplied by the unit compensation for that risk. So in this case, we have a case where this is the market risk premium for an individual or a particular unit of risk. In this case, one beta of 1. So that the multiples of beta you have will determine how much risk premium will be added onto your base rate to give you your expected return on any particular security in a well-diversified portfolio. So this is how it plays out. The expected return, the risk-free rate, the beta of the security, and then the market risk premium. So if beta happens to be 0, which is this product then disappears. It means that your expected return on that security is just the risk-free rate. If it happens to be 1, then remember that this is 1, then you're going to get your market risk premium, which we add on to this, which gives you the RM that we computed earlier. Now, when you are able to put that on a graph, what you see is that at beta of 0, we have the risk-free rate. As beta increases, then the expected return also increases. Bear in mind that beta is a measure of the systematic risk of an individual security. So even though the average investor may not be able to do anything about systematic risk, individual securities vary differently depending on how the market plays out. Some are more sensitive, some are less sensitive to the market. So this sensitivity here is what is going to determine your overall risk premium for a particular security. So this is it. At 0, we have risk-free. At 1, we get the typical RM. And if it keeps on going on and on and on, the higher the beta, all things being equal, the higher the expected return. So we can plot a case with beta of 1.5 and you see that it goes on to 13.5. So that brings us to the end of our lesson, and these are some things you need to take home with you. First, you need to know how to compute the expected return and standard deviation for individual securities, and then you should also be able to do same for a portfolio. You should also be able to tell the difference between systematic and unsystematic risk, and also tell the factors that drive these different risk frameworks. You should also be able to tell which of those risks is relevant when you want to determine expected return. And then you should be able to practice some more on assets with various measures of beta with different risk-free rates and market returns. You should be able to compute the expected return on those assets. And that is the end of our lesson.